Angel Medina here. On today's video, I'm going to be going over, should I do a second HELOC? Does that make sense for me and my family? So again, on today's video, I'm going to be going over the second and all the things you need to know about doing a HELOC, which stands for Home Equity Line of Credit. So if you do have equity in your home and you're thinking about taking some equity out and you're trying to decide whether you should do a new first or to do a second, I'm going to go over some valuable information that you need to know before you make that decision. So again, thank you so much for watching this video, Angel Medina. And if you are new here, I would ask you to please consider subscribing to my channel. And if you notice next to the subscribe button, there's a little bell. Go ahead and hit that bell. And that will actually notify you anytime any new videos are uploaded to my channel. So again, thank you so much for watching this video. Angel Medina, your lifelong mortgage advisor. Thank you. Okay, so on today's video, I'm going to be going over all the things that I tell somebody who is thinking about pulling some equity out of their home and they are looking to do what's called a HELOC. Now, the HELOC stands for Home Equity Line of Credit. A lot of times people think, well, I'll just get out 20, 30, 50, 100,000 and I don't want to mess with my first, and it makes more sense for me just to get a second. So now the thing I want to tell you about the HELOCs that you need to know is that when you are doing a HELOC, you need to know that the rate is going to be an adjustable. So it will never be a fixed rate. So that's another important thing that you need to know. It'll be based upon a margin. So whatever the margin is plus the index. Now the index is something that, again, it makes it an adjustable. So the rate can adjust, meaning your payments could potentially go a lot higher. Now, depending upon when you do it, depending upon what you agree to, but just understand that it is an adjustable of how high the interest rate and payment could go up. The other thing I want to go over with the equity lines of credits, what they were originally designed for is somebody, yes, who gets a line of credit, uses it, and then pays it back and then closes it out. But that sounds good in theory, but most people don't end up doing it. They usually will get the line of credit, they'll use it, they'll pay the minimum payment, and that's another thing that looks very attractive is the minimum payment. Now the minimum payment goes towards interest only. Now when you pay interest only, that means that your principal balance will not go lower. So what happens is you typically will be paying every month. It'll say a payment. Even though they will notify you, hey, this is interest only, you won't really think about it and you feel good because you're making your payments on time. But then after a while, you start to notice, wow, my rate is going up and I still haven't really seen my balance go that much lower. So the reason that I would highly tell you not always just to do only an equity line of credit is because when you do a line of credit, you'll typically see people over 2 or 3 years, if you do it, end up refinancing after a year, 2 years, or 3 years. The reason that doesn't always make sense is because if you qualify for a line of credit, an equity line of credit, that's if you qualify. Now they're sometimes even harder to get than a first. Let's say you do qualify for a line of credit, then you have to understand that you're going to not only pay any fees associated then to get that, but you're going to end up refinancing very quickly once you realize that you have a high rate and it's going higher and the principal balance is not going lower. Now I've had a lot of people say, well, I'll just pay it off, or they've already paid it for at least 2 years and they'll tell me originally I was just going to pay it off, but I didn't want to touch my first because I have a really good rate. Well, you have to understand, if you have a first and you have a second, the numbers don't lie. You have what's called a blended rate. So you want to add the interest rates that you have with both of them, and from the time that you keep them, you divide those numbers into 2, and that's your overall blended rate. Now that may make sense if you only keep it, let's say 6 months, a year, 2 years, but eventually if you do decide to do an equity line of credit, you will eventually want to consolidate the first and the second and get one low payment. Now, me personally, I always tell somebody, if you're doing a line of credit, it makes more sense to do one loan versus two loans. And the reason being is you're going to end up realizing that your balance is not going lower, your rate's an adjustable versus a fixed rate. And typically, people who do a second equity line of credit end up refinancing and paying more fees to get into one loan. So why not do one loan from the very beginning, get an overall lower rate and get an overall lower payment and have a fixed rate? Because typically with a HELOC, a home equity line of credit, they sometimes will entice you by giving you more than what you need, and you'll say, well, I'll just use the minimum. But typically, I would say 8 out of 10 times, people end up using more than they should. And it gets really difficult. The reason I do everything is I don't want to ever put someone in a situation for my benefit. It's always for your benefit. I'm going to not tell you exactly what you want to hear. Well, not tell you what you want to hear at all. I'm going to tell you what you need to hear. Now, I know it sounds good that you want to pay off the second and you're going to pay it off in 6 months to a year, but typically that doesn't happen. And typically what happens is if you don't pay it off, eventually you'll realize that you need to consolidate the first and the second, and that'll take away more money out of your equity, which is money that you could have used for you and your family. So the home equity line of credit, the times that it does make sense is if you're refinancing. In order for you to refinance and to do what you want, that's the only option you have. Or if you're purchasing and they include a second and that's the only option you have, then yes, that would be another good option to use the HELOC. Another good option is if you are somebody who is an investor and typically does get large loan amounts, business loan amounts, and you want to do a HELOC because it's going to be more favorable being self-employed to you, then yes, I would say that would make sense because you know that you typically get loans and you pay them off right away within 6 months to a year. But again, you have to make sure that that is normally what you do, because the thing about that loan, because it's an adjustable, because you're only paying interest only, the longer you stay with it, the more you're just paying interest and the higher the rate could go throughout the life of the loan. So again, I hope this video helps. This video is basically because I get a lot of people who want to take equity out of their house, but they talk to their bank and their bank tries to tell them all the reasons they should do a second. And when I hear these things, I understand why the bank teller or this person is telling them to do a second, but it doesn't make it right. They're doing it because that's what they're told to do. So the reason that I am doing what I do for my clients, again, is to treat them like I want to be treated and give them the information that I would want. So again, I hope this video helps. If you're new here, I would ask you to please consider subscribing to my channel. And if you notice up top, there is next to the subscribe button, a bell. Go ahead and hit that bell. And what that bell does is it notifies you anytime I have any new videos uploaded. So thank you so much for watching this video. Angel Medina, your lifelong mortgage advisor. Thank you.